Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of the respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media are identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. All right, so let's see how we're doing as far as the market goes. It's been a very exciting day, up and down all over the place. I can't believe the Dow was like almost positive for a minute. It was so funny. Look at this crap. So we were here, then Gary Cohn resigns, and the market dropped all the way to 24.4. So basically from 24.8, so we dropped 450 points, basically on resignation of Gary Cohn. Then we clawed all the way back to 24.8, just under being green for the day. And then, of course, for no particular reason, we drop another all the way down to 24.5. So we drop another 300 points. And so currently we're still down about 300 points. Now, without getting too explaining about it, the Russell, oh, wait, we got to use RTY now in the Russell. Hang on. RTY. You can't use TF anymore in Thinkorswim. They're not going to honor it. So anyway, so since the Russell is still way up and everybody else is turning back down, I'm going to just short one there, and I want to show you laddering in for one thing. So I'm in at 1565.50 right here. So that's my base. Now, I have conviction on this trade. I think they're all going to tank. Okay, I think it's going to get worse, not better. So the Russell is like way green. It's in fact up half a point for the day pretty much. So I'm willing to have conviction on this trade. So even if it goes back to 1572, I'm going to stick with it. But of course, my goal is always going to be to lower my basis when I can. So I'll show you how we do that if it goes that way. If it doesn't go that way, then I'll just make money on the way down, which is not as good of a lesson, but you know, can't purposely lose money. Oh shit, look at it go. And that's how you make $45 in 10 seconds. All right, anybody else? So let's take a look at what else is going on. That one was important because it was too, I was dying to make that trade, but I figured I'd wait for you guys to get online because it was so stupid. Because, look, it's pretty simple, really. You just compare them all, and you say, well, look at the Dow. The Dow just fell all the way back to almost its lows. The S&P is back to almost its lows. The NASDAQ is only halfway up, but the Russell is trading near the highs. That doesn't make any sense. So unless you think everybody's going to catch up to the Russell, you bet the Russell to go down. That's what we call shorting the laggard. You want to short whoever's lagging. You want to go long whoever's lagging on the way up and short whoever's lagging on the way down, because the indexes don't generally go off by themselves. The NASDAQ can, because of Apple, can just drive the NASDAQ up and down anytime Apple does something. The Dow, an individual component, can move the Dow, but you got to check, and then you got to look and see if any of those things are happening to affect the index. But if not, and especially if you see identical patterns on the Dow and the S&P, see that W there is almost identical to this W here. When you see an identical pattern like that on two main indexes, you assume the other ones are going to catch up and do it themselves. So he's got an almost identical pattern, not as far resolved on the NASDAQ. But then this guy's out in space. He's really where this guy was back here. And that means this is kind of an easy short, right? And everybody else is below the pink line by two, he's one this is a standard deviation. He's one standard deviation below the pink line. He's two below, he's one above. They got to be joking. What special benefit does the Russell derive from steel tariffs? None. You know, these are small cap stocks. I mean, I guess the only benefit they have is they don't get affected either way. What do they care what the price of steel is? But it's still not. You know, I mean, it's just such an easy setup when you see something like that. I mean, we had a really good setup in gasoline. So gasoline and oil both went the wrong way this morning. So I called the oil short at 62.50, and I called gasoline short at 195. We didn't quite make 195, but close enough. And we had nice plunges here. I mean, these are huge moves for oil and gas. Very big profits. Natural gas does not care because we are exporting more and more natural gas every day. And they just put a new terminal online. Coffee hit 120 as usual, where we like to go long. What a weird chart. What's this thing? That's 10-minute chart. No, everybody's a 10-minute chart. Oh, because KC is not trading anymore. That's why. That's the wrong KC. Is it? There you go. So coffee hit 120, where we always like to take a long on coffee. And anyway, so we'll just see what happens right now. Oil now at 60, I would probably want to take a long poke on oil because it wasn't the build in oil wasn't that devastating. So if we're going to test 60, that makes it kind of interesting for a long play. 60 is way down here though, so that's, you know, we'll see what happens. But I don't love oil. I don't have any particular reason I want to go long, but 60 is pretty, you know, I imagine that's going to get defended. And you want to check out Brent. Do we have Brent? Who am I going to sacrifice for Brent? Let's sacrifice $1 because he's not really doing much. BG is Brent. I thought it was. Wait a minute. BZ is Brent. Sorry. BZ is Brent. So Brent crew, we'll see if it hits a significant spot. Now, okay, see, Brent's at 64, and it looks like they're trying to defend 64 on Brent. That will, by, you know, can't think of a good word, but by being connected, by just being both oils, if they defend Brent at 64, then our oil is going to go up at wherever it is at the time. It doesn't matter that it's not at any even number. So we'll see what happens here. Okay, we're only 10 cents under 61. I'd rather play over 61 if he keeps going up. So we'll see how that pans out also. So on the whole, you know, this is all just a big mess from the tariffs. And look, the market does not like uncertainty, and you can't get a straight answer from the White House. You still have, you don't know who's going to replace Gary Cohn now. Gary Cohn was a moderate for the Trump White House. It's not a moderate in general. I mean, they're all radical conservatives, but of the radical conservatives, he was a moderate. This trade thing is dangerous, a terrible precedent. Vladimir Putin just said, you know why I'm upgrading my nuclear weapons? Because the U.S. government is falling apart. That's what he just said. So he's worried that we're too crazy. That guy must be laughing his ass off, I got to tell you. All right, so where are we on that Russell trade? Let's see if we made any money. Made $100. That's not so bad. Now, made $100. Everybody's turning a little bit green, so there's no point in risking it. So I'll just sit there and buy it back. There it goes. Boom, locked in $100. You don't, I mean, if you make $100 in 10 minutes, lock it in, be happy. That's more money than most people make in 10 minutes. Then you look for a fresh horse. So if he goes down, like we're at 63, if these guys start breaking down, if he breaks down below 2,700, if he's down below 24.5, if he's down below, well, he's already down below that green line, then you pick somebody else to short. But when you make really quick money like that, and you see that the trend isn't definitely in your favor, you get out. Take quick profits and go, and it'll either bounce back or it won't. But meanwhile, as I keep pointing out to people, if you make $100 twice a day, that's $200 a day, and if you can consistently do that 200 trading days a year, that's $40,000. That's just extra little money playing futures. So, don't scoff at like $100 gain. It's a perfectly good thing to lock in, because you can do it over and over and over again. All right, let's see if we have any questions or comments or whatevers. How did you get Winston to read the blurb? That's the standard English audio for the computer. All right, what else is going on? Maybe we should check on our portfolios. Hang on. And again, this is an absence of me looking at the news, by the way. So, the problem with the webinar is I'm not reading. Usually when I'm at my other computer, because it's a separate computer to the ones I usually use. When I'm at my computer, I'm watching the news stream all the time to see if anything's changing. I'm listening to the TV in case anything happens. Because I want to know if anything changes from minute to minute. If I hear some good news, time to get out of the shorts and see what happens. I don't mean get out of the shorts, like definitely get out of the shorts. I mean, if I hear something good, I say, oh, wait a minute, maybe I should take that money off the table. In this case, I was just going by the visual. I start seeing these guys turn green, and I say, okay, maybe they're going to come back up. Let's see what happens. He's close to the bottom of his W. He's close to the bottom of his W. They might all head back up into the close. For what reason? I have no idea, but they might, so you never know. So let's see. First of all, what? I'm like, somebody here must know me. We have a problem with our WordPress, and our computer guy has no power. He's one of those people who has no power. That's why we can't get it fixed. I only just found that out. He's sitting there in the dark in Pennsylvania. It's been a few days. All right, so no actual news came in here, so I'm not going to look there. I'll take a look over at Seeking Alpha real quick just to see if anything's happening before you start going on to other things. Seeking Alpha. News. I like their news feed. Although this is something's wrong here. Market News Live feed. All right, well, I'll just read the headlines, I guess, because mine shows the whole thing. I don't know how to adjust it. GE battery storage. Well, that's interesting. Cryptocurrencies falling on the SEC warning. We know about that. Well, that was so obvious. How's Bitcoin doing? XBT, I believe, right? Yep. Oh, that's not so bad. I said that from day one. I said if they become a threat, the governments are going to start putting rules on them, and that's that. Icon says, no insider trading. I just happened to sell a stock that was highly dependent on steel days before Trump announced tariffs. And yeah, come on. What an idiot. But the bottom line is he's basically saying, prove it. You can't prove it. You can't prove he knew. You can't prove Trump knew anything. How are you going to prove Icon knew something? Shale gas production could triple oil by 2050. What does that mean? What does that mean? Now, they don't mean the price. I imagine they mean the quantity. Could raise their share of natural gas production to 3 times. Oh, I see. They're going to produce more natural gas than they do oil, is what they're saying. All right, meanwhile, we're all the way back to noon, so nothing has happened. Okay, there really is nothing has happened. So there's no reason for the market to change direction. So any change of direction you see now would be for no particular reason, which means this is still probably the best short. Unfortunately, you just got out of it. But the Russell is still a very good short. That it's very unusual for these indexes to break below that second support line there. That's called S2, support 2, and it's what you call 2 standard deviations, 1 standard deviation, 2 standard deviations off the predicted track. So it's not usual for you to for 1 standard deviation happens all the time. 2 is a lot. So you would still look here for some kind of bounce. And if we don't get a bounce here and we go through, then we go right back to shorting the Russell or the NASDAQ, one of those two. And the NASDAQ just failed this line, so that's not looking good for them either. But anyway, on to other things. Oh yeah, portfolios, right. So let's see how we're holding up. That's important to do. Every once in a while, we want to check and see if you're still holding up. Client login. Portfolio. So here's the options opportunity portfolio. Mostly in the OOP, we got a couple of things that are hitting us hard. We're down 3%, but we have a lot of positions. So, you know, when you establish positions, it costs money because you've got the bid-ask spreads and so on and so forth, and the broker's always telling you the worst case scenario for each position. So it doesn't look good when you have 23 positions basically in 2 months that we've added. So there's a lot of cost in establishing these long-term positions. Meanwhile, we're losing $1,000 on that hedge. That's not a big deal. ABX is hitting us for $4,000. GE is hitting us for about $4,000. Harmony, not Harmony, whatever you call it, movie pass people are down a bit, but we still like them, so who cares? Northern Dynasty, big hit on Northern Dynasty. We knew this is very speculative, though. They're all the way down to 93 cents. We bought them at 140, and we're just waiting and seeing. We're not in a hurry. You know, this is again, a very long-term speculative play. I just read up on them, and I posted something this morning. They're moving forward with their environmental studies. Everything's moving ahead. All that ever happened to them that tanked the stock was the EPA said, we're going to look at this thing very closely because it may have a bad environmental impact. They have to say that. And you know what? They say that the same way that Donald Trump says that he cares about the kids and wouldn't want the dreamers to suffer. Okay, it's the same thing. That's what the EPA is saying about the fish. They're like, well, we wouldn't want to hurt any salmon, so we're going to do a study. And you know what the study's going to find out? Study's going to find out, hey, you know what? Mining isn't bad for salmon. The salmon love the mining. They love like toxic runoff in the stream. It makes them go faster. You know, they'll believe me. It's not going to happen. It's like it would be so weird for them to suddenly pick on this one company to not permit them for anything. So there's one loser. But so our biggest losers are Northern Dynasty and GE. So Northern Dynasty, which we still like, GE that we still like, Movie Pass we still like, and Chesapeake is, I mean, it's not really a big loser. I'm not going to count that. It's like $1,500 down. So we have a few of them that are down. Those guys are costing us like $20,000 at the moment. So that's why we're not profitable here, because we have a few positions that are costing us a bit of money. Unlike the long-term portfolio also, because in the long-term portfolio, we have, I think, the same positions in the long-term portfolio, but we also have some bigger positions that we don't have here, like Apple, that we couldn't afford in this portfolio because it's too small. But this, you know, Barrett Gold, you know, so proportionally we get hurt a lot more by these losers. But none of them I wouldn't want to stick with. So I'm not too worried about it, actually. It's just when, you know, we're off to a slow start. That's all I would say about being down 3% is we're off to a slow start. We do have $61,000 worth of positions. So that's quite a lot. I mean, we're pretty heavily invested. So now we just have to wait for them to mature, that's all. In the In the butterfly portfolio, we only have one stock. That's down 3% too. We only have one stock. It's OIH, and we just have to wait for them to come back. People are going to spend a lot of money on projects in the oil services industries. So I'm not worried about them at all. So that's a nothing thing. The Money Talk portfolio, interestingly, they took a big hit. They're down 52%. I'm not sure why. We lost money on our hedge, obviously. Apple, still good, but not as good as it was. Oh, Barrick Gold. We have Barrick Gold there, too. We have GE there, too. Oh, okay, now you can see why. IMAX, Limited Brand. No, it's really those two. It's really GE and ABX. And it's the same story. Just let them move along. The long-term, the short-term portfolio is funny. The short-term portfolio, because we were very active on managing it on the way down. So in the short-term portfolio, wait a minute. Yeah, so the short-term portfolio is up 50%. And because what we did is when we hit the bottoms, we got bullish, and then when we got back up, we got more bearish, and we pretty much timed it perfectly each time so far. So this is up crazy $50,000 for a $100,000 portfolio, and it's only there to protect the long-term portfolio. The short-term portfolio protects the long-term portfolio, and it turns out the long-term portfolio doesn't need any protecting. It's up 11.3%, and that's where the bulk of our money is. That's a $500,000 portfolio. So, and like I said, it's got the same things. Here's ABX here, which is down $8,000. It's just that we have more positive positions that are doing well. A couple of really big ones. We don't have Apple. Oh, what do you know? I thought we had Apple in this portfolio. Interesting. Okay. Oh, we got Chipotle. Chipotle's doing very nicely for us. Who's this? FNSR is not doing well. GE not doing well. THC doing very well. Tenet's a big profit piece for us. So just a slightly better mix than we have in the same amount of plays. And we don't have Apple here. I thought we did. Frontier is profitable. That's a new one. That's never profitable. Sometimes you just got to stick with things. We stuck with Frontier all of last year, and it took forever to turn it around. They're finally starting to turn around a little bit. So, the long-term portfolio is very diverse. So lots and lots of positions. We really still have a ton of cash. We've got only 76,000 total market value in the positions. 480,000 cash. So we're actually using very little cash and getting very good results from our cash. So all these portfolios are generally in really good shape. I mean, the fact that we're flat for the year doesn't matter. What matters is that we have a huge amount of positions. And in fact, on the next review, I don't want to promise it if I don't have. I'm going to try to do that thing where I show how much money we expect to make on each position. Because as far as I know, in the options opportunity portfolio, we're probably set to make well over $50,000 this year. So, the fact that we haven't made it yet is not a tragedy. But when you have a $100,000 portfolio and you're planning to make $50,000, as long as you're more or less on track, it's okay. All right? This portfolio is going to make $150,000 this year. And it's already on track. It's already up 50,000. And the funny thing is, though, the short-term portfolio, which is a hedge for this portfolio, is also up $50,000. So we're up $100,000 between these two portfolios already, which is about combined 15% on 600,000 we started with. So that's good. That's really good. I mean, and again, that's just because we were super nimble with the short-term portfolio. But that goes back to the thing I was talking about yesterday, which is we're trading, there's nothing special about what we're doing. All we're doing is watching the charts. And here it is. So very simply, when this happened, we cashed out our hedges. Okay? Now, had this line broken, we would have we would have uncashed and we gotten short again. But it didn't. What happened is we cashed out our hedges, left in some protection, but mostly we became a bit bullish, went back up here. We get back to the top of the range. We say, oh, let's put those hedges back on again. We put the hedges back on heavy again. We get back to here. We cashed out our hedges again. It's not complicated. Then we get back to here and we put on our hedges again. It's really not that hard. And then presto, we're up 50% because we just keep going in and out of the thing. That's like in a month, look at these opportunities. These are huge moves. These are massive, massive moves, and they're so predictable. These are lines that we drew, ages ago. This 20% line on the S&P has been the same 20% line for about a year for us. We predicted this as being a market top a year ago. We knew exactly where the S&P was going to top out. It went a little higher than we thought, but the bottom line is this is where we thought it was going to top out. So, these lines are lines that we use all the time, and we can watch them. And when they get into now, even if it goes above our range, there's still a range that we can watch because we know what the significant support line is. And that's what we use for our 5% rule. It helps us chart out what's going to happen. And here you go on the S&P. We went all the way up to 30%, way past what we thought. But still, look at the ranges. We go up 5%, pause, consolidate. That's a good consolidation, by the way. Then we go up again, pause at the 2.5% line there, consolidate some more, move up to the top, small consolidation, and another move. But this is not enough consolidation, which is why this move was a little bit overdone, which I was screaming about the whole time it was going on. Then we go back down, since we didn't have good consolidation, go back down, test it, fail, go back down, test this area, better consolidation here, in fact, much better consolidation here, but this is a pretty wide swinging consolidation. And then we go marching back up, coming back down. So next, so you can see okay, we went from this zone, broke over it, and once you're here, you say, okay, I guess we're playing this zone now. And then you draw your lines within that zone. Then you get to the next zone, you break over it, and you say, okay, I guess now we're playing this zone. You get to the top of that zone, you say, okay, I guess now we're playing this zone. And then we came back down here, and here's the zone we're making all the money in, because this zone is holding up really well for us. That zone, if you zoom in, is this. But that's all we're doing here. That's what the 5% rule is. You'll on 15, 20, 25, and then within that, we break those up. And we can see exactly what's happening. And this was, whose is this, Goldman or Bloomberg or somebody? Oh, I forgot who made this chart. Looks like Bloomberg. Anyway, so here's a chart with some annotations and so on and so forth. They're using the Fibonacci lines. The 5% rule is not that different than Fibonacci. Because Fibonacci, what do we have? We have a 40% weak retracement. And what does Fibonacci have? Fibonacci has a 40% retracement off of the move. So it's very similar because it follows the same thing. I made it when I made, and don't forget, I made up the 5% rule. It's not a thing. I made this whole thing up, but it works. But when I came up with the 5% rule, I was very well aware of what a Fibonacci rule was. And it's basically applying Fibonacci retracements to computers. Because that's the underlying premise of the 5% rule is that the market is driven by computers, not by people. And when you see them obeying these 5% moves within, moves within moves like it does, that's when you know you have a huge amount of computer selling that's driving the market, which frankly in this market these days is all we have. That's the only kind of moves we do have. Oh, I'm glad we got out. I see the Dow's moving back up. Oh, wow, look at that. Now that's a nice line. See that? 6,900 again. So who do I want to short now? Now that we have this incredible pop for no reason, who do we want to short? The Dow got rejected at their green line. The S&P is just over their green line. The Russell is at this red line here. That's where we started shorting them before. But the best short, I think, because it's the easiest stop out, is going to be the NASDAQ. So let's hit it right there. Nope, didn't fill. Oh, now it's running away from me. There it goes. Okay, so now I'm in right at 68.99. And very simply, I should stop if it goes over the 6,900 line. I'm just betting it's going to get rejected at the 6,900 line. Now to confirm that, now that I've got my entry, I want to watch to see that everybody's getting rejected. I definitely don't want to see the Dow going above this 60, basically 24/7. I don't want to see the Russell going above, so let's call this the 6,750 line. And this is up, what, like 60 bucks already? So if anybody even ticks a little bit up, I'm going to take my 60 bucks off the table. Because again, when you make 60 bucks in 10 seconds, take it off the table. Unless you're sure that it's going down further. I only picked it because this is a great line to stop at. But if I'm going to ignore the fact that it's a great line to take a profit, it makes no sense. Up 35. Up, that's better. 55. So I'm watching all these guys, and I'm in my mind, I'm making sure nobody goes higher. I don't like that. He goes 650, 52. I don't like that. I want to see him failing 24,650. I want to see him go below 1250. I want to see him below 6750. That's exactly the opposite of what I want to see happening. Now he's going down. He's down and he's down. All right. Now that might entice me to hold. If everybody's going down but the one I'm shorting, I still might end up holding on to it because it's, you know, it looks like maybe he's just a little bit late and getting dragged down. Oh, that's good. 60 bucks. 70 bucks. Come on, 100. 60 bucks. Now I'm going to put see, now that I've gone there, I want to put a stop at around 50 bucks. I'm going to take my 50 bucks off the table because if it's not going to work, then I'm not in the mood to like sit there and stare at it. So right about here, I think I would stop it. And now I know that's 75, so as soon as we move to 100, I'm going to put a stop at 75. 90, in fact, now I'll put a stop at 75. Yeah, might regret that. 90. Come on, baby. 85. There you go, 95. Come on, 5 more bucks. Oh. $90. Come on, baby, you can do it. Everybody's moving down. Join the crowd. Now, see the where am I? 96. So he's at 30, 31. He's at 10. He's at 66. So I want to see these numbers going lower, not higher, on the other ones. 11, 33, 66. Not working. So I'm going to just take this 90. Whoop. Oh, wow. No, there's 100. All right. Oh, no. Now I took them both, so now I'm positive. Shit. All right, wait. Oh, that worked. That was funny. I accidentally I accidentally sold two. I accidentally bought 2 back. I ended up positive, then it ticked up, so I took the 20 right off the table. So 120. All right, so now we're up 220 so far in this session. Good. Now we can get back to learning something. Why did I come here in the first place? What was I looking for? I don't remember. Questions? All right. How is the hedge fund doing since inception? I don't know. I have not looked lately. Doug runs a hedge fund. I don't run a hedge fund. We have a Chinese wall kind of thing. He uses trade ideas that we have in chat, but it's not under my control because I don't want to influence, I don't want to influence a hedge fund like that because because I tell people trade ideas. If I want to tell him the same time I tell anybody else, and I don't want to be involved in like what he's actually trading in a given minute. But last I heard, it was doing good. So we'll have a report at the end of the month. At the end of March, there'll be a quarterly report. But yeah, I'm a hands-off guy on that. My job is just to, we have a meeting once a month. We sit down, we look over the thing, check the portfolio, but I'm not involved in like actually placing trades or anything like that. So, because so in other words, he gets an idea from me the exact same time anybody else in chat gets an idea from me. He decides to follow it the same way anybody else would decide to follow it. That's the rule for the fund. Okay, FTR, are we doing debt positive or negative? No, they're doing exactly what they're supposed to do. FTR is they suspended the dividend so that they could buy back some stock. So they suspended the dividend and they started buying back some stock with the money they saved from suspending the dividend. Perfectly natural, exactly according to plan. So I don't think it's not a negative and it's not really a positive either. It's really just sort of like things are going the way they're supposed to. When would Celgene look attractive to the long-term portfolio? Sell puts initiate and bull call spread. No, never. Last I checked, and I'll check again since you're asking. Last I checked, Celgene. My problem with Celgene was that they had gotten very expensive, and I used to like them. They got very expensive, and they're lower now, so that's good. But and they made some bad acquisitions that I didn't approve of. They spent too much money to acquire. They didn't have much of a pipeline, so I couldn't see them justifying where they were. I can't give you an easy answer on them now because, unfortunately, where is Celgene? Oh, hang on, I got to read your questions. Unfortunately, I don't know how they're doing with the acquisitions and how much cash they used up and so on and so forth. I haven't looked that over yet. But look, they're running here 2.9 billion profit there on 13. Here they've got 4 and losing money. So, we don't like that. Balance sheet, they got 7 billion cash, 5 billion short term, 15 billion debt. Assets, you can take them or leave them. Cash flow, maybe the cash flow shows a different story. Cash flow is good. So they've got some weird accounting going on. It's going to take them a while to settle down. Bottom line is let's assume that they can get back on this track where at $11 billion, they've dropped $2 billion to the bottom line. That's probably an aberration more so. You got 1.6 out of 9, then you go 1.9 out of 11. This obviously includes something strange. So, there's one thing that's non-recurring. So you have a negative $1.3 billion non-recurring expense. So if you back that out, this becomes 1.6, which makes perfect sense given that they've gone to 13. So if we assume 1.6 and let's say they can ratchet it up to $2 billion if all goes well, then I would expect to pay no more than $40 billion for the company. And how much is the company now? $67 billion. So it's expensive. And the PE you see here is based on some wacky financials that you don't know for sure they're going to actually hit. What are the analysts saying? Analysts are saying that's crazy. Analysts are saying $7 a share. See, that's weird because they're not earning that in cash. So it needs to be looked into. But my take on Celgene, but again, that was back at that was when it was in the 130, 140 range, and I was like, I can't buy the stock anymore. Now it's gotten to a point where it might be buyable again, but I got to really look at it carefully. So remind me in chat. Because I'm going to have to now look at the whole company all over again and figure out what the hell they're actually doing these days. Conceptually, I like the company. I just didn't like the direction they were going for a while. HRB is making a big move today. Oh, well, we knew that. Earnings beat did not seem large enough to justify that I missed something. As I've said, though, HRB is a very seasonal kind of play, and it really only takes them not to screw up, and people are reminded that they make all their money during tax season. So when they're cheap going into tax season, as they almost always are because everybody forgets about them, because look, it's a very seasonal company, so they make no money in the fall. They make a ton of money here, right? Then they report earnings, and then it's all downhill from there. And then they make no money during the rest of the year. They got nothing going on because nobody's doing their taxes. And then everybody forgets about them. And then all of a sudden in the spring, everybody's like, oh my God, it's a company that does taxes. And they shoot back up. It's the stupidest thing. And then they announce their earnings. Everybody's all excited for a few minutes, and then they go back down again. So we like to catch them when they're down in the spring, and then we catch them for the move up. And I don't know, 14%. Wow, that's a big day. Anyway, so we already have them, of course. We have them in the options opportunity portfolio, I'm pretty sure. Yeah, so what we did, and it wasn't an aggressive position, we sold 5 of the $25 puts on the 19th. So let's see, January 19th. Where was that? Is there a closer chart? Yeah, here you go. All right, so January 19th, when they were up here, we sold 5 of the $25 puts because I said this is going to be the floor. It turned out not to be the floor. They went lower, but that's okay. Then, also on the 19th, we took a spread, and it was the very unaggressive 22-27 spread. So again, when it's trading over here, we took the 22, way down here, 27 spread, the 200-day moving average, and that was our play. And we took I didn't think it was very long term, was it? HRB. It's this January, medium long term. So we just say it's going to hold 27 by January. What do we pay for the spread? 57.50 minus 3,000 is 27.50 minus 2,000. So we paid about $700 for this spread, and it's going to pay back $5,000. So that's a nice little play. All right, so far it's up $1,500, so it's going to be good for another $3,000. So that's a good little play. But it's always a good play in the spring. We love H&R Block when it's cheap. So, you say the beat didn't seem large enough to justify, but it doesn't matter. Justify, they're trading at such a stupidly low price. That's the thing. People don't understand this about earnings. It's not about what price was it the day before earnings. It's about what price historically should it be at. So when they beat and they're way below, I mean, look at the PE ratio. It's 15 on these guys. And that's a real 15, because I'll show you. It's they make, obviously, $400 million. Okay, not much variation there. So they make about $400 million. And you can buy the entire company for, sorry, I have to keep closing the question box to get some away. And you can buy the whole company for $5.8 billion. So yeah, there you go. Less than $6 billion on $400 million in earnings is a PE of exactly 15. So that's cheap. And all they have to do is outperform that by a little bit. And you say, well, then 27 was a stupid price. Or 25 was a really stupid price, because if it's 25, it was even lower than that. It doesn't matter what they were yesterday. It matters where what's a realistic valuation that they have to get back to. This was a stupidly low valuation. This is a realistic valuation right here. Is a realistic valuation. So, don't get sidetracked by saying, oh, they were here. Why do they go up so much? Because they never should have been here. That's the problem. This was stupid. If they were here and they went flying up to here, then I would say that's stupid. But that's not what happened. They were here. They should have been here, and they had a little bit better than expected earnings, so they squeezed out a lot of people. But look how quickly they're settling down anyway. So realistically, we're going to see it'll settle down about 27, but it'll settle down at our target, which is 27, and it's going to probably drift along there for the rest of the year. That's our plan. Very, very reliable trade every year. Salmon love mining. That's an interesting way to put it. Oh, salmon love, I see. Yeah. Wait, I guarantee. Wait till you get the EPA report. You'll see. We'll come back to it when it happens. What would be a good new entry for OIH? Wherever it is right now, it's too cheap. OIH. And here you're just betting on a basket of oil service stocks. It doesn't matter what they are. We're just betting more money will pour into the oil service sector. That's all. As all this money from the industry comes back in, as all these projects get going, as people start deep water drilling again, especially, that's going to really kick it off. This thing will go up in price, and it will probably drift back into about close to 30. Somewhere like between 27 and 32 is probably the right place. So it's a bit low now at 24. And and again, it's not about, you don't need to be aggressive with these things. Oh, look, we're popping back up again. This is fun. So let's take OIH. So, it's not, it's an ETF. It's not going to go bankrupt. So you could sell the 20, you can sell these 24 puts for 350 in 2020. So there's 350 in your pocket, and all you have to do is buy it for 24 if it's below it. So forget what you're netting in for. Just consider that free money. Instead of buying the stock now, you sell the put for 350. So now you get 350 in your pocket, and you didn't buy the stock. But you got the money still to buy the stock if it happens to come around. And you take that money, and we pick a realistic target, which is 27 is an easy target. And so you say, well, I'm going to get 265 for selling the $27 calls. I've got 350 in my pocket, so I can easily afford to pay 550. And the 21s are 550, so you can do the 21-27 spread. But really, I think I go for these. I go for the 20s. Those are going to be call it 630. So 630 minus, I think I'd do the 26s. So since I'm going to do the 20s, I would do the 20s for 630, sell the 26s for 310. So now you're netting in for $3.20 on the spread. It's a $6 spread. You're selling the 24 calls for 360. So you're going to have a net 40-cent credit on a $6 spread. So you'll make at $26, which is only $2 more than it's at now, you'll make $6.40 profit, which is 25% of the stock's current price. If the stock goes up $2, if the stock goes up 10, if the ETF, if it goes up 10%. So that's your leverage. If it goes down, you're going to lose money. If it goes below 24, you're going to own it at 24. No magic beans here. If it goes down below 24, you're in at basically 24. So you will lose money if it goes down. If it goes up even a tiny bit, though, you're going to make back $6. You're going to make 25% of what you would have made if you owned the stock entirely. But that's a nice way to play it, okay? So you're just leveraging the upside. You're not leveraging the downside at all. You lose no more money. In fact, you lose 40 cents less because you have a 40-cent credit. You lose 40 cents less on the way down than if you bought the stock. But on the way up, you make 25% if this thing goes up 10%. Now, if it goes up 50%, you still make 25%. But the point is, you make the 25% of the stock's current price. I mean, you're actually putting out basically no money at all. In fact, watch, if you sell 10 of these guys, which would obligate you to buy 1,000 shares. So if you sell 10 for, what do we say, 350? No, 360 did we say, right? Oh, somebody's doing it. That's why somebody's doing it while we're talking. If you sell 10 of these guys for 360, your margin effect is $2,200. So that's all you have to do, and then 10 of these spreads will pay back $6,000 or $6,400. So against $2,200 in margin, you're going to make $6,400 on this spread. That's a nice play. Oh yeah, see, somebody just filled a 360. That was easy. But that's all it takes. It's a very nice conservative play. The big mistake people make with options is they say, "Oh, I've got all this fancy leverage. Let me like mortgage. Let me just risk everything and make 100 to 1." You can do that, and if you get lucky, you'll do that. But you can make 3 times your money, 3 times your margin on very conservative plays. So why wouldn't you do that? Because you can make a lot more of those. Like I said, look at the long-term portfolio and the short and the options opportunity portfolio. We have a lot of positions. We're very diversified, so we have a lot of positions that are going to make like these are going to make very, very nice returns if all goes well. If it doesn't go well, we're not going to get killed by leverage. We're just going to end up owning some stocks and whatever, and then we'll work on them from there. Costco got too expensive for me, Rich. He says thoughts on Costco at 190. I have a 219 position from the old portfolio. Roll to wait. Oh, the butterfly portfolio, I assume he means. Roll to that's an interesting way to abbreviate a butterfly portfolio. Roll to the 2020 or take off the table. I think Costco's a bit expensive here. I mean, unless it went down more than I thought. Some of these guys I haven't looked at in ages, so I couldn't tell you. I like Costco. I like Costco because they were cheap, and then they got expensive, so I didn't like them anymore. Oh wow, look, they did come down a bit, but not much. It's just no longer cheap. It's not a bargain. I don't remember when we started playing. We started playing, they were like down around here, in the 130s, and now it's like, when it got up to the 180s, I lost interest in these guys around here because it's too much. And again, we can look at Costco, but I like to buy stocks that are bargains. I don't want to buy them that are not bargains. See, the PE of Costco is 30 for Costco. It doesn't make any sense. It's a freaking retailer. I know everybody thinks they're Amazon now, but just because Amazon trades at 300 times earnings doesn't mean that 30 times earnings is a bargain. It's too much. All right. Anyway, can you review your thesis on Valiant VRX? When do you plan to roll the March OIH short 29s? They expire Friday. Well, we're certainly going to roll them before Friday. Short 29. What are those puts? OIH. I guess that must be in the butterfly portfolio. Yeah, we sold some March 29 puts in the butterfly portfolio, so we're just gonna roll them along, and we're gonna sell some more short calls, and that'll be that. No big deal. So that'll happen next week when we do the review of the portfolio officially. What is your thesis on VRX? My thesis on VRX is they finally got cheap enough where I got interested. I mean, I haven't liked them. I warned people off them for a year. It was the exact opposite of pounding the table. Every time people went into VRX, I was like, why on earth are you buying this stock? It's like a criminal operation. But now it's more or less cleaned up. And at the heart of it is a company with $8 billion in sales. And they're capable of making, they're capable of making $2 billion in profit. They're going to drop a good amount to the bottom line. It's hard to tell exactly what the clean numbers are, but here's every quarter is weird for them, but they're capable of dropping quite a bit of money to the bottom line, and the main point is take away everything else, right? My premise for these guys was I look at this very steady $2 billion a quarter in sales, and then I go to Pfizer, and I say, okay, Pfizer, how much money do you make? And Pfizer says, well, we sell $52 billion worth of crap, and we make $21 billion. Well, that's ridiculous. Let's say in a normal quarter, we make $7 billion. So they make 10%, almost 15% drops to the bottom line. So now I go to Merck, and I say, okay, Merck, what do you do with money? And Merck says, well, we have $40 billion worth of sales, and we make, in a normal quarter, we make $4 billion. So it's 40 and 4, 40 and 4. So we make 10%. So somewhere around 10 to 15% is what $8 billion worth of sales is. So Now I go back to VRX and I say, okay, VRX, you should be making $800 million. How much can I buy your whole company for? I can buy the whole company for $5 billion. So if they were making a normal amount of money, it would be $800 million on $8 billion worth of sales. And in that case, they should easily be worth $8 billion. Should easily be worth 10 times earnings. They're trading well below that. They're trading at whatever the hell that is, 54, about 6 times, 7 times earnings. They're trading at 7 times earnings. They can go up 50% from here very, very easily. So we didn't make a highly aggressive play, but they're cheap, and they're so cheap, and also small enough where Pfizer or Merck can just buy them. They can just sit there and throw $8 billion, even $10 billion at them, because for $10 billion, it works. Just adding that money to the books of Merck or Pfizer, the deal pays for itself in 10 years. So there's the premise. I look at it as a buy. I look at it from an M&A perspective and say, yeah, I'd buy them at that price. I'd give them $5 billion. And if I give them $5 billion, there's certainly people dumb enough to give them $10 billion. So, because I'm cheap. So in the options opportunity portfolio, the play we added was we sold the $15 puts because they're at 15. So this is the price I'm willing to put my foot down. And we speculate that they can go up 50% to 22 over the next 2 years. Now, the net of this trade is actually a credit. We got a $4,600 sale. It's a $100 credit, and it's a $7,000 spread. So anything over 15, we make money. At 16, we make $1,000. At 17, we make $2,000. At 18, we make $3,000. So anything up from here is $1,000 profit per dollar. Again, fantastic leverage on a $100 credit. And like the other one, there's virtually no margin. The margin on this is like $1,000. So we have very little margin at work. We can make $7,000, and it seems like it's not very risky. That's the premise. What are my thoughts on SWN? I'm not they're okay. I go back and forth on them. People ask me all the time. I don't know why everybody's so interested in SWN. But they're a pipeline company, and stuff moves in the pipeline. But they seem cheap. I think they have a lot of debt. Let me see. Am I right about that? No, not a lot. I mean, well, a lot. Only $6 billion. So they got $6 billion in debt, and it's a $2 billion company. So that might bother some people. I think that probably keeps people off them. Financially, though, they're fairly steady, but their revenues are in decline. This is what I don't like about them. I mean, they don't make any money, so they lose a fortune. They don't make any money. Their revenues are in decline, and it's hard to say what normal is for these guys. So, and also the liquefied natural gas. I worry for all these pipeline companies. You can't transport liquefied natural gas by pipeline. In theory, obviously, you would pump the natural gas through the pipeline, but at a certain point, they're going to start like compressing the gas at the site and taking it in trucks because it's way cheaper. The truck is much, much cheaper to transport the natural gas than the pipelines are. And these guys are the guys who take the tolls at the pipelines. You can't shoot liquefied natural gas in a pipeline. It's way too dangerous. But you can, in theory, especially when there's no regulations in America anymore, you can put it on trucks and send it out. And they'll just be one of those trucks. You go behind the truck on the highway with a big warning label that says dangerous gas, and it's got like the fire symbol on it, whatever. And you're like, oh, Lordy, don't hit me. So there'll be a lot more of those on the road. That's probably what's going to happen. So it's not unprecedented. We do this all the time. We transport oxygen, which is 100 times worse than liquefied natural gas, but we transport that in trucks. So it's not a very far leap to say why, and any gas operator is going to say this, they're going to be like, okay, why are we paying these pipeline guys to slowly transport all this natural gas through these pipelines when we can compress it right here at our site, put it in a truck, and send the truck out? And all we got to just pay one trucker for one haul instead of a month worth of pipeline. Because it is 600 times compressed, 600. So that's very, very, very compressed. And I don't know what the ratio is of what it goes through the pipe at, but I'm telling you, it's definitely more economical to just put it in a truck. The only question is how much is the compression on site and what do you have to have and so on and so forth. But that infrastructure, when you have these basins where they drill the natural gas, it would make sense to have a compression place at the basin that all those guys pipe into, and then from there trucks go out. That would be the most sensible, sort of a hub and spoke kind of thing. In fact, if somebody wants to put that together, it's a good investment. So anyway, so that's the problem with Southwestern Energy. That's why we don't have any of that kind of stuff. It's a changing industry. We don't know how it's going to be upended. They've got a huge infrastructure investment, and if there are alternatives to shipping the natural gas out that bypass them, and of course, don't forget also new pipelines coming in. They're still doing like the TPP and things like that. You start doing new pipelines, and all of a sudden they might get bypassed there too on some profitable routes. So unless you really, really study this thing and know it like the back of your hand, which I don't, so I don't know, I'm just speculating one way or the other. It's not necessarily a business that I want to be in for the next 20 years. So therefore, and generally if that's the case, I want to be in the business. How the market's doing. Charts. Oh, it's hopping out of the same old place again. That's funny. Can't get over this hump. That's not good though. It's the same problem we had yesterday, but now it's just sort of like, it's weird, right? Because it's coming to the same basic places, still having trouble in the same places as we had yesterday. And except yesterday there was a shock that sent us much lower. But you see this? Hitting this resistance, can't get back over it. Hit this resistance, can't get back over it. Hit this resistance, can't get over it. And this guy's right at his resistance. So if he starts failing, it's time to go short again. And once again, I have conviction where I would short these guys as they get back in the 6,900 range up here. So in fact, 899, 899.5. So let's hit one. There we go. What? Oh wow! So I'm short at 69.5. In fact. So now we're back on that one again. This is back on the NASDAQ shorts. And now what I want to see is I don't want to see him going over 70. If he goes over 70, I should get out. So basically, I'm watching the Russell to stay under 70. I'm watching him to stay under 12.5. It's the same place it was before. And I'm watching him to stay under 650. So there's 85. Let's see if we can get another 100 out of this guy. 95. Wow, that's going to be fast. Yeah. I'm going to take 75 off now. Bonus money. Boom. All right, so now we're up to 195. This now we've made 295, 395. Wait, no, 295 on those trades. And notice I'm thinking you can do this all day long. Just watch for something to hit resistance points, check it with the other guys, and make a quick in and out. That's all. So while we're sitting here, and how long has it been? They said, what is it, like 1 hour. Basically, it's been an hour, made $300 already. And it's fairly random. I'm not staring at it. I'm just every once in a while I check to see where we are. Now here we are at 50 again. Oh, didn't make it. And here's about discipline too. I'm not chasing it. If it hits that spot when I look at it, then I'll take it. So he's 68.5. He's at 12. He's at 34. So my next, the one I would go here is now here. I'm at 67.50. So if this guy starts falling, I would switch to the Russell for a short. Because again, they have a long way to go down. So either he gets to 69.50 or he goes to 67.50, and one of these two guys we can short now. 9, 80, 99, right here. Nope. Here, kitty, kitty, come on. Because this does not look to me like we're consolidating for a break higher. It looks like we're just basically failing. You know, we're bouncing weekly, and in fact, that was a bigger bounce. Notice this is a bigger bounce, and then this is a weaker echo of that bounce. So these are not very impressive moves right now. $7.11, 20. He's gone down 25 points while we're watching it. So that makes me more inclined to jump on something. So let's take this one. Because we'll stop him at 70. So this is 68.50. 1568.50. We want to stop above 70, which is way up here. So that's a no-brainer. And now I don't want to see him go over 69. I don't want to see him go over. I'd like to see him go below 25, frankly, to confirm it. I'd like to see him go below 10. Then I'll feel better about it. Until then, I want to keep a sharp eye on this thing. We're down $5. I don't like losing money. There we go. Now I'm up 20. Oh, here's a good trick also. If you put your stop over here, like you move it so your stop is up there, it reminds you to get the hell out. Like if it's your stop, it looks literally like you should be getting out. I don't want to give up any money. I want to make a little bit more money. So 9.5. Nope, 9.6. That's no good. 9.5 again. 9.4. Yes. Okay. Oh, 9.5 again. That didn't last very long. All right. So I'm not getting the action I wanted. So I should get out. Oop, where'd it go? Shoot. Where the heck is it? That's not good. 99 again, 98.50, 99. Remember I wanted to short him at 99.50? He never hit my goal. That's funny. 12.25. I don't like the way this is going, so I'm inclined to just get back out and take my money out. 99.25, 99.50, where I wanted to short. I'll short him. Nope, ran away. Now it filled. So I like the Russell better than I like this one. I want to get out of this one. So I'm going to take a quick profit here, $5. Very happy. Now I have 105. And now I have the short that I did want at 99.50, and very simply, if we go up over 6,900, I get out with a very small loss. Because that's a good line in the sand. That's something you can play off as a backstop. Now, I don't want him to go over 70, so if he goes over 70, even if he's not over my target, I'm going to get out. But I think that's probably a good spot. In fact, here you go, 60 already. That's pretty good. So what's my goal? My goal is, oh, wow, look how fast it came back. That's ugly. What? What? Holy crap. What the hell just happened? Wow, that was awful. I just got hosed. The thing flew up on me. All right. Now, is this being confirmed anywhere else? No, it is not. So since nobody's confirming it, I'm going to add another one. Shoot. All right, right here. So now my average is 0.3. Because it spiked up for no apparent reason. The other guys are not confirming it. So I'd rather double down than take a loss. But that's how fast you can go from being positive to negative. Now we're down 260 on that one. Whoa, 10. Now if I add another one, it ran away. If I add another one, it would bring both of them up about 3. Whoa, okay, here you go. Nope. It's funny how if I put the order in, it won't take it. He's still below 70, but he's coming up. Oh, that filled. So now I'm in 3 short at 505 at 5.5. I'm just hoping. See, now I'm going to play this until it gets over here. This is pretty high. This is 615, 616. But this is what I wanted to show you with scaling in before, so it works out except for the loss. So now, see, on the way up, I added. So I brought my net up from 69 to 69.05, but on 3. And the idea is if we get back to 69.05, I immediately reduce back to the one that I had in the first place. Now, the next time I would want to add would be at least 15. Or 20, actually more like almost 20, because if I add another one at 20, that'll bring my average up to 69.10. You always got to be aware of that. It's like, what's the effect of adding going to do? But that's pretty high, so hopefully we don't have to do that, because that would be a pretty big loss while I'm waiting. And I'm doing this because he still hasn't hit 70. He's not hitting, he's not hitting his green line either at 69. 24/7. So he spiked up all by himself for no particular reason that we know of. Unless there was a reason, but I don't think so. Anyone see anything on the news? What do we have? Oh, the beige book is out. Damn it, there might be a reason. Okay, so probably the beige book had a decent look. That's not good. I probably shouldn't have done that then. I don't know. Do I want to read the beige book before I get out of that? Is the beige book a good enough reason to change this? Key responsibilities, Fed filling spots, blah, 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 blah. Okay. Hang on, let's take a look at the beige book. Let's get a new thing. And let's just look. B-E-I-G-E. Beige book. I don't want to read it. I want to find an article on it. All right, businesses are reporting labor market tightness across the United States. How is that a positive? Is that today? 12 minutes here. Accelerating wage gains. Well, that's a positive. A report bolstered the case for interest. Wait, in a report that bolstered the case for interest rate increases, the central bank's assessment appeared to indicate slight strengthening of the labor market since it issued the beige book. Across the country, contacts observed persistent labor market tightness and brisk demand for qualified workers, the Fed said in a report, a collection of anecdotal information from the business assembled. Several districts reported continued worker shortages across most sectors. So they were reported by business technology and marketing. The Fed also noted that 4 of its 12 districts saw a marked increase in steel prices. What? That's funny. That's before we even have the tariffs. A marked increase in steel prices due to a decline in foreign competition. Trump announced tariffs. That totally cannot be connected. Overall, U.S. economic activity expanded at a moderate pace. Price gains were moderate. The Fed said those are similar to those. So they're still seeing no inflation, but they are seeing labor wages inflation. They don't like that at all. So they're still going to be on tightening mode. They're expected to raise rates later this month at their meeting. The Fed policy makers projected 3 increases for 2018. They also raised rates at that meeting. So we're going to have 4 total raises this year. We're still on track for that. While the beige book is not a systematic score. Okay, that's not a reason to have the market go higher, so I'm still into this short. Now I just have to decide how badly I want to stick with it. We're still not at 70 on the Russell. We're still not at 20 here. We're still not at 75 here. I mean, we're still not at 700 there. So I'm still into sticking with this thing. Now, if I add one here, because doesn't seem to be going much higher. If I add one there, it's only going to add 12 is only 7 higher than 5, which means then divide that by 3, and each one of these guys would move up 2 points basically. So I'd be at 707. Not really worth it. So I'm just going to wait. Right? In other words, if I added one more short, at 12. It wouldn't be worth it. So all I'm going to do is add 2 points to this thing. So I'm not going to do that. I'm just going to wait and watch and see what happens. But like I said, I have conviction on this. I really think we're going to end up going lower again. So I don't mind holding this thing out. Well, it'd be nice to actually make money while we're doing it, but let's see. Okay, 12 I do. At 12, I don't really want to add. I want to go back. I want to be at least 13.5. That would be 8 higher. That's where I want to sell another one, 13.5. Not going to hit it. So I guess I should probably take, So I guess I should probably take 12 and be happy because it's not going to make it. Oh well. So now we'll watch and wait and see what happens. See, but that's the thing. It's not just the one you're looking at. It's got to be confirmed by the others, and you have to understand why. So when you guys said the beige book, which thank you, by the way, because I didn't realize we had the beige book out. When you say beige book, I'm like, oh, that's why we spiked. So now we know why we spiked. Then we say, well, was that a good reason to spike? And it isn't, because really, if you read the beige book, it's on the one hand, the beige book says the economy is going well, it's strong, wages are rising, blah, blah, blah. On the other hand, though, that means more tightening. And the overriding effect of more tightening is not a positive. It's not a net positive. And neither are the rising wages for corporations. And I think that metal thing is terrible, because if the metal situation was already getting bad and Trump just made it worse, I don't know what anybody is celebrating here. All right. Qualcomm, Broadcom, too much noise. Some launch Qualcomm short of for Broadcom. Yeah, but there's now they're calling it a national security risk. Is your thoughts on whether the merger goes through? No, stay away. I would stay away. You don't know what the hell is going to happen now. Once the government starts messing around and telling you that they think something is a national security risk, first of all, means that there's going to be endless hearings about it. It's going to take forever. It's going to drag out, and I don't like it anyway. I mean, I was always a Broadcom fan. I never liked Qualcomm as much as Broadcom. I was always a big Broadcom fan. Broadcom got bought up, and now Qualcomm's buying up the combined Avgo, whatever. I'm not interested. It's all gotten very, very expensive. I lost interest in Broadcom when they became part of Avgo, and now Avgo's getting brought up by Qualcomm. They're paying multiples upon multiples for this thing to form a monopoly that's certainly not in the national interest. If push comes to shove, I agree that this thing is a security risk. Just look just like Intel is. Intel should be broken up, because it's that chip thing in Intel where there's an exploit that was being hacked. That's a national security risk. Every computer in the country uses their goddamn chips. That's what you call a national security risk. Can't states get an injunction against the tariffs? I don't know. I don't think so. Look, well, the Congress, the president is saying that it's somehow a national security issue, that they're enforcing tariffs under national security. You have to first appeal that to the Supreme Court, which is Trump's court, and we'll get more so by the time one more justice goes. It'll become totally Trump's court, where he'll have 6 justices. So first, you got to get past the Supreme Court and say the president doesn't have the right to declare steel a national emergency. That's step number 1. Until you get there, the states can't override anything. Then you have to say, do the states have the right to override the federal government's tariffs? That's also very questionable. So, it might sound good, but you can't do it. Look at the sanctuary thing. The sanctuary hearing is going to be a big deal. So the federal government is taking California to court, saying you can't impose sanctuary zones. You can't have a zone where you say the federal law doesn't apply here. That's what they're saying. And look, being that California is not an Indian reservation, I don't think they can. Now, on the other hand, what California should do, though, is make a deal with the Indian reservations and let them be sanctuary zones. Because they could, that's what I think that should happen all over America. I think all the Indian reservations should get together and become sanctuary zones and set up like a much bigger country. Like they'll become a fairly large country inside America. That'll be funny. Oh, here we go. Okay, got our money back. Now I'm not going to let this go away. So if it's unless it's not worth messing around. So I'm going to buy one back now. Oh, theoretically. Oh, you bastards. So in other words, there's no point in increasing. I mean, I increased my amount to raise the basis, to get a higher basis. But there's no point in doing that if you're not going to lighten up when it comes back to where you were. Oh, come on. That's not fair. Really? Bastard. Almost had it. This guy's too busy yapping. He's still at 69, 69.1. No wait, 27. No, he's the one that's got to go over 2,700, 24/7. He's okay. Oh, I can't believe that just happened. That's annoying. Oh, here we are, 11 again. I guess I'm gonna have to add that 12. Here we go. 12.25. All right, pull it. Look at that. No matter what I put in. Oh, there it goes. Okay. So now my average is 07. We were just below 07. So now if I add another one at 12, that's only going to pull up the 4 will only get pulled up about a point. So 08. I don't mind that actually. I wouldn't mind adding another one, come to think of it. Because then my average will be 08, and that's a very easy get. Or hopefully the whole thing doesn't keep spiking up on me. I want at least 12, though. I'm not budging on that. Well, thank you. All right, so now I'm at 08. So now I definitely want to get out. I'll even put an order in here just in case, so it at least reminds me when it gets there. So there's my target now is 08. And if I can get back to 08, I reduce back to 2. And then I've got 2 short at 08. When we started off way down at, I forgot where we started. We started 05 or we started 69? No, we started below 69. So we've raised from below 69 to 69.08 is our basis now, and we have 5. So that's what scaling in is. I keep adding a short, raising my basis, but the point is I have to have the expectation it's going to come back down to this price so I can scale back out. If you can't scale out, what's the point? You're just going to be increasing your losses. So based on my interpretation of the beige book and what's going on right now, I think that this is a irrational move up that should be reversed. And so we're going to wait and give it some time and see what happens. 09, very exciting. Come on, come on. 0850. Oh, you bastard. Yes. There we go. And now I'll sell that one for sure. There's another one out. And I'll take another one out. Nope, it's not giving me that one. So you see, I put that in. It spiked down. I got it. I immediately went to fill another one. Now it went away from me again. But now my basis is, now I've only got 3 short. And my basis is way up. Well, it's still at 68, of course. But my break even is now here. It's all the way up at 69.10. But I don't want to break even now. I was up $195 here. I want to get back to being up $195. So I still want, at 69.08, I still want to reduce to another one if I can. It's tricky though, because you trade. You know, I mean, at a certain point, we were down $300 off that trade, which was originally up 200. So on the set, I was down $500 on the 5 contracts for a little while. You know, so playing with conviction. Now, compare that to my original thing where I said we should stop out. When it spiked up against me, I said, well, I couldn't stop out, so I decided to add to the trade. But the stop out trade, you have to be sure no event is going to happen to make it spike over, which we hit an event. But with the stop line, I wouldn't have lost anything. I would have been in good shape. 0825, 0850. What do you think? Lock it in? I'm being greedy. Where are you? All right, I'm not going to fiddle around. Oh, come on. Oh! You bastard. See, he's at 69.5. I don't want him to go over 70 because I'm really going to want to get out of this trade. So I was saying, when against me, I started working on improving my basis so that I had a better way to exit and I would have a more realistic strike to hit. But if those go against you, they can go against you badly. I was down $500 for a little while. Well, 500 from where I started, down 300 from total. All right, half a point. Come on, give me the half a point. Don't be mean. Come on, baby, please. Please. Ugh, so annoying. They can see me. That's the problem. They're trying to tease me into selling at a higher price. So I'm going to get out again. These bots that do the trading, they can see these. They can see your orders. Don't think they can. And so if you have an order in, they'll try to punch it. But that's good though. If they won't hit me on the way down, it probably means that they're looking to go down. We'll see what happens. Now, if we get back to 12 again, now if I add, I'm going to increase my position. So I have two-pronged attack now. If they go down to 8, I want to buy it back. If they go up to 12, I want to sell another one to increase my basis. So either way, I'm good. It's just waiting for them to make a decision. Here's 70 though. That's not good. I really would like to get out now. He's still 678. So these guys aren't threatening me, but the 70 I don't like to see on NASDAQ. I'd feel a lot better if I did not see that. Up 70.3, even worse. You know, even though he was at 72, but I don't want to rationalize out of this thing. Oh, 875. All right, don't be cheap. There you go. Up 775. Down to 1. And 656. All right, now my stop is going to be at 7. And now it's going my way. Whoa, what just happened? Holy crap. Look at it go. 902, 901. Look at that. All right, that's good. I'm happy. All right, so now we're at 340. So now we're at 445 in 2 hours. Not bad, huh? That's old money. That was from earlier. But anyway, all right. So meanwhile, yeah, okay. So there's another 1,000 I made earlier today. So that's $1,400 for the day. And again, there's 200 days like this to trade. So that's all you got to do is learn how to trade these things. It's really just practice, 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 and you've got to have that discipline. And I know a lot of you guys watch what I just did and say, well, why didn't he hold those things? He would have made more money. That's not how you play, though. You know, all right. Well, let me clarify that. I play that way, but not for teaching purposes, because I'm trying to teach you a good stopping discipline that keeps you out of trouble, not to show you like the radical cowboy gung-ho stuff. I love the radical cowboy gung-ho stuff, but I love it because I know how to scale in and out of positions. And even if I have, here's the weird thing, even if I had 5 shorts or 10 shorts here, right, and it goes way against me, and I'm down $10,000, let's say, I would still add 4 more shorts. And then when those 4 shorts make $1,000, I would get out of them. And that means I'm only down $9,000. Then it goes up again, and I would add 4 shorts again. And when I make another $1,000, I go out and take another $1,000. And eventually I'm I just got a weird message about the audio. Did you guys stop hearing me? All right. Anyway, hopefully you guys heard all that, because I got a weird message about the audio going out. All right. Should be back now. Well, that's not helpful, but how does that work? Oh, send to all. Yes, I guess means you can hear me. Okay, good. Anyway, so what I was talking about was just basically how scaling in and out is, that's what you need to practice before you start messing around with like the more of the conviction type of trades, which are very dangerous. And obviously you got to play within your means also. You can't play and win and lose $10,000. You can't play if you win and lose $10,000 if you don't have $10,000 to win and lose. And I don't mean have 10,000 like in the bank. I mean have 10,000 like money you would have played at a poker game anyway. You got to keep things in proportion with this stuff. You can't mess around if you don't have the kind of money that you can lose. The tight stop discipline, where I said you should stop if it goes over 69, that would have saved me a lot of trouble. But on the other hand, I probably wouldn't have made that money on the other end. I wouldn't have made the extra $100 and something that we made on this one. So, scaling in with a bit of conviction is useful, but only if you can afford to do it. All right, so given the situation, and again, the problem is I can't keep up with the news. I'm really going by technical here, which I don't like to technically trade these things. He's going up a little bit. He's over my 70 line, so this is a no play now. We can't play this anymore. So now we need to just move along and do something else. So anybody got exciting questions? Okay, good. All right, so position-wise, I think we're in good shape. Let's take a look at the, where are the Finviz charts? Here we go. Let's take a look at these guys. See if we can get an overview of what's happening. See, now keep this in mind. On the daily charts, you get all caught up in here's the short-term view, right? Here's 5 minutes. And you go, ooh, whatever. And here's the hours. But then you look at the daily chart and you say, hey, wait a minute. We were here, and we were here, and we bounced to here, and now we're not even getting back to where we bounced to. This is not strong. There's nothing strong about these charts. And the VIX, by the way, is not doing anything. The VIX is just sitting there. The German index is down at the lows. The Euro stocks are down at the lows. Japan is at the lows. We are ignoring the rest of the world at the moment. But the drag is here. And God forbid these guys, if these guys start failing these levels, and with the trade war, it's very likely they will. So if this trade war bullshit continues and he fails 33 and he fails 21,000 and he fails 12,000, these are all significant lines for these guys. So first of all, these are all very significant lines. They damn well better be bouncing off them. At least bouncing off these lines, not going straight through them. They are bouncing, but if these start to fail, we're going to get dragged right back down to these lows where we were. And that's a big fall. On the S&P, you're talking about another 100 and something points, which is $5,000 per contract. On the NASDAQ, you're looking at 69 to 63 is 600 points. That's $12,000 per contract. On the Russell, we're looking at 70 to 100 and something points on the Russell, which is $5,000, $6,000 per contract. So we're looking at some very, very significant falls. And that's just to get us back to the lows that we had a month ago. And these guys are already there. Europe's there. Japan's there. China's probably there too. So this is not exciting. Until we clear back over this line here, there is not really a bullish market. Okay, we could easily go back to here and double top, which is, now the Nasdaq's the bounciest, obviously. The Russell's a little bit over, so we want to watch the Russell carefully. They're making the best move up, but if this move doesn't entice the DAX and the Euro stocks and the Nikkei to move up also, then it's worthless, because they're going to be like dead weights on the rest of the indexes. Now the Nikkei, if the dollar gets stronger, the Nikkei could get pretty bullish here, though. Doesn't look like the dollar's cooperating though. All right, so on the energy space, how are we doing? Oh, we did get that bounce in oil. Where are we? Yeah, see, oil did come back off 61. That's why I thought they were going to defend that line. That would have been a good bet. Gasoline popped off 190. That was obvious also. All right, so that was good. Natural gas still going strong. Good. Bonds are surprisingly not getting killed from this, but the bonds are also deteriorating back to their lows. Let's go daily. See, actually, they never left, right? The bonds are still like dead weight. Look at the 2-year with the gap down that it never recovers from. That's awful. Soft coffee is back down to where we like to buy it. 120, we like to buy coffee. Whoa, look at cocoa, man. Holy crap. That's from 19 to 25 almost. That's massive. That's like 25%, 30% run. Wow. I don't know what that's about. Metal, gold, silver, platinum, copper, It's not very exciting. Meat, who cares? Grains. Some of them have chicken. They have everything but chicken. Grains, corn getting very expensive. Soybean meal, soybean oil, cheap. Soybean meal, a lot. Soybeans, a lot. Why would the oil get lower? Weird, huh? Wheat, canola. Oh, that stuff is gross. Nothing exciting there. I'm going to Vancouver, so I'm glad the Canadian dollar's cheap. Nope, not very much going on, so I guess we're going to wrap it up. It's not a little bit unexciting. Let's see. Let's see how our portfolio has been affected by all this. So the OOP, minus 4.5. Holding steady, minus 4.5. LTP, 11. Oh, these guys are holding pretty steady. We just did the OOP. Short-term portfolio, amazing. That's it. And the money talk, 55.9. So nothing very exciting going on during the session. And we'll see how things play out. Somebody wants to get a hold of me pretty badly. See, once these guys are breaking up, you can't get in their way, but this is it's not that, like I said, in the bigger perspective, it's not that exciting. So I'm just gonna have to wait and see what happens tomorrow. Whoops. All right. Anybody else have any questions before I go? I think we're good here. It seems like we're just gonna have to watch and wait and see where we finish. Don't forget though, on the S&P, it's all about the 28 line, 27.28. So that's right here. And this is the line that they keep failing, which is that's their strong bounce line. And if the S&P can't make it, it doesn't matter what anybody else does, then we're all probably going down. Hey, Phil, you were saying that it isn't a good time to do butterfly plays. Why is that? I would have thought it was better during a higher VIX. The VIX isn't really that high. It's only high compared to the incredibly low place it was. But the VIX isn't that high. And the market is way too unsteady. The whole point of butterfly play is you want to sell puts and calls against a steady stock. There are no steady stocks. Things are going up and down 10%, 20% in a month, and you can't be sure about the money. So the thing that blows up a butterfly portfolio is when the stock goes flying on you, like OIH. Like the one thing that we did pick up, because I didn't want to get into any stocks because I was worried, I've said, okay, OIH is generally pretty steady, and look what happened to them. That was our first test for the butterfly to see if it was a good time to get in, and look what happened to OIH. It's done this in the past, but when it's here, we came in around. Oh no, where did we come in? Sorry, we came in up here, and it went up 20%. Then it went down 20%. So it made two 20% moves. Well, that's more. I mean, I'm sorry. That's 40%. It made a 20% up move on us. Then it dropped back 20%. Then went another 20% down. Then comes 20% back up. This is a freaking ETF. You have to find stocks so they remain steady. We can't even find the index. SPY goes up and down 10%. So how are you going to sell short puts and calls when you have this kind of motion in an index? This we don't mind because we can deal with that. We can keep rolling up and deal with the rolls. This, though, is a nightmare. You can't play this when you're selling puts and calls on both sides. It just means we're getting burned on both sides. It's not worth it, so we wait. That's all. It's not a good time to play the butterfly. And the VIX on the whole, we're not getting paid enough money to take these kind of risks. That's why we don't do it. All right, so how do we do in the end? Let's see. We made 340 plus 105. So we made 445, which is good for the day. That's nice money, and we're happy with that. And I don't have any definite things that I think are very playable right now because everything's been moving about. But I would say, all right, well, definitely if we hit 24.8 again, I would go short there. That's a good one. 27.28 is easy to short here on the S&P, and if we break above it, get right out, and if we break below it, just wait and see how much money you collect. Those are the best ones right now, but you don't really want to mess around when you've got, when you're over 69 now on the NASDAQ. They don't really have any upside resistance until they get back to 68.50-ish. So it's not really the best time to be shorting on those things. Oil, gas. Nope, nothing else exciting to play right now. Even silver is too high. I'd love to go long, but it's too high. Obviously, coffee, though, if you get another shot, they're closed. They stopped trading. But if we get another shot at 120, for sure. I already have the long on my coffee for that. And natural gas, I have the longs on that one, too. This is V8. This isn't the current contract. This is a V8 contract going out to, when does it go out to? I forget. October. So, at $3, I'm going to take the money and run. But that's a fantastic run we've had from, I think we started 260, so it's a lot of money. All right. But you can see these lines here, right here. It's a good line there. And the Russell, wow, here's a good illustration of how far the Russell is ahead. Look at this thing. Way up here on these major lines. It's miles above. He's barely this pink line. He's below the pink line. He's below the pink line. They are still running away with it. So really, all right, I have to say I do like this short. At 75, I definitely like that short if we hit it. Just, just out of principle. It's just ridiculous. So we'll see what happens. But on the whole, again, we're not really making any constructively bullish plays. I still like to have the very balanced portfolios with the hedges. I want to be careful about that. And next week, we're going to do a portfolio review. So it's going to be a lot of shifting around next week, probably, right? Thanks, everybody, for coming. I appreciate it. And have yourselves a lovely week. Oh, wait, somebody said, can you show how you draw the pivot points? I don't draw them. When you right-click on the chart, it says studies, and you say add a study. And then you say trend studies under P for pivot points. See that? Take a picture. Add a study. I'm pointing my finger. That doesn't help you. Add a study. Trend study. P, pivot point. So right click on the chart that you're on Thinkorswim. That's how it works. All right. Thanks, everybody. Have a lovely week.